All right, here we are again for week 2 of derivatives. So let me just get everything open. Let's see. All right, so basically this is a more intensive overview of what we were doing last week. We're taking a closer look at these different types of contracts. For example, we'll be looking more closely at the properties of forwards and futures contracts. We're going to take a look at how to determine the forward price of an asset, which means that when you enter into a forward contract to buy, let's say, gold in 6 months for, let's say, $1,500 an ounce, the question is, where did that $1,500 come from? Why is that the correct forward price for an ounce of gold? So we're going to see that the forward price is actually derived through a very precise mathematical formula. And we'll see what happens if the price is off from where it should be. Anyway, and we'll see how futures contracts are marked to market and why futures prices will converge to spot prices on the maturity date of a contract. We'll be looking at how forward and futures prices are related to each other, and finally, how to hedge risk with futures contracts. So we're basically zeroing in more on forwards and futures this week. Last week, we had a nice broad overview of these topics, but this week we want to zoom in on them and maybe take this to the next level and understand even more deeply the different features of forwards and futures contracts and how they're similar to each other, how they're different from each other, how prices are determined, and how they can be used for hedging strategies. So we're basically, it's almost like we're putting all these same topics under a microscope to learn more of the important details. All right, so we've already seen that a forward contract is simply an agreement where we can either buy or sell an asset at a specified date in the future at a price that's been agreed on today. And that's the key to the whole thing. If it weren't for that, then this contract wouldn't be very valuable. It's the idea that we can lock in the price at which we can buy or sell something in the future. That's what makes it possible to hedge our risks with a forward contract. Now, it's that price that we want to analyze a little more closely today. Where does that price come from? How is it determined? Well, that's a good question. So forward contracts can be written on many different types of assets, such as stocks and bonds and gold and currencies and anything you can possibly imagine. And they don't have to be written on financial assets either. I mean, you can certainly buy a forward contract on other types of assets. For example, you can buy them on, let's say, industrial metals like copper and zinc and nickel. You can buy them on variables that are not, strictly speaking, securities, like interest rates, for example. An interest rate is not actually a security, but you can buy a forward contract, which enables you to lock in a rate of interest at which you can either borrow or lend in the future. That's a special separate category, which we'll be looking at some point in the future. Those types of contracts are specifically meant for hedging interest rate risk. And so they're very, very powerful and flexible and very popular on Wall Street and in financial institutions where they probably own a large quantity of bonds. Anyway, we're going to start out by assuming that we're writing a forward contract on an asset that does not provide any income to the owner. Now, what exactly does that mean? Well, if you own, or let's say you enter into a forward contract on the British pound. If you actually own British pounds, you could earn a rate of interest by keeping them in a bank, let's say a British bank that is paying you interest based on the British rate of interest. So owning a currency means you could be earning an interest rate if you keep it in the proper bank, of course. On the other hand, gold does not provide any actual income to the owner. If you own gold, if anything, you might have to pay storage costs to keep it somewhere. So gold does not provide any income to the owner. And many other securities do not either. Stocks sometimes provide cash flows in the form of dividends. Bonds, certainly, as we know, will provide interest payments to the owners. So in the case of a forward contract written on an asset with no income, this is the formal relationship between S0, which is the spot price. By the way, I just want to mention, here's a convention that we will follow. If you see a variable with a subscript like 0 or 1, typically that subscript refers to time. So this would be the spot price, for example, at time t. And 0 means today. 1 means one period in the future. And that period doesn't have to be a year, although it often is. It could be a month or a week or a day, whatever the case may be, but 0 would be today's time. 1 is one period in the future. And of course, that means that 2 would be 2 periods in the future, et cetera, et cetera. So these zeros here are meant to indicate these are the current prices. S, of course, is the spot price of the asset. F is the forward price. The capital T is the maturity of the forward contract. The forward contract calls for delivery of the asset at some point in the future. We call that the maturity of the contract. So if, let's say that you agreed to buy gold in 1 year, capital T would simply be 1. If you are agreeing to buy gold in 6 months, then we would normally just approximate that with 0.5. Okay. Now, R is an interesting, we have to define that very carefully in a second, but first I want to draw your attention to this E here. E, like pi, is a constant, and it has an infinite number of digits after the decimal point that do not repeat themselves. We often see E used when we calculate how much to pay on a loan or how much we might receive from lending money. It is commonly used in finance to calculate how much money we may have in the bank in the future, or how much we might have to save today to have a certain sum in the future. So it's a very important value that we will see over and over again. And in these derivatives models, we tend to see this on a regular basis. And so basically, let me just do a little detour here for you, just to give you a better feel for what this E is all about. Oh, it looks like I've already done that. Excellent. All right. Well, I forgot that this was here. So let me skip ahead a little bit here. There's an example here of how important this E turns out to be. Imagine the following situation. An investor deposits $1,000 into a bank account for 2 years that pays a rate of interest of 4% compounded quarterly. So that means 4 times a year, you're being credited with 1% on your outstanding balance. How much will you have in your account at the end of 2 years? Now, this question is equivalent to saying, what is the future value of this sum? So how would you figure that out? Well, there's a couple of ways we can go about this. Oh, by the way, I just want to save this real fast. So let me show you one way we could do this. And you'll agree that this is a fairly time-consuming process. What I could actually do is say, well, all right, well, I've got $1,000. And every quarter, yes, I'm going to earn 1% on the outstanding balance. And this is going to happen 8 times over the next 2 years. So what you could do is multiply the $1,000 by 1.01 8 times, or 1,000 times 1.01, whoops, 1 to the 8th power to represent the payment of 1% per quarter 8 times over the next 2 years. So if you multiply that out, 1.01 raised to the 8th power times 1,000 is going to give you $1,082 and approximately 86 cents. Rounding it to dollars and cents, this is how much you'll have in 2 years. Now, if we had compounded the interest more frequently than this, we would have actually had even more, a higher future value. Or in other words, a bigger balance in our bank account in 2 years. But first, what I would like to show you is that what we just did can be reduced to a formula. And this formula looks like this. Okay, this is what we're talking about here. This formula can be used to calculate the future value of a sum. The P is the sum, or principal as it's called. R is the annual rate. And N is the compounding frequency, as it says up here. And in this case, using that example we just had, oh, and by the way, T is time until the investment is maturing. And so if you plug in these numbers, 1,000 times 1 plus the annual rate of 4% divided by the compounding frequency of 4 times a year, the exponent is 4 for 4 times a year times 2 for 2 years. And it reduces to what we just saw, 1,000 times 1.01 to the 8th power. And so, of course, we end up with 1,082.86. Now, the nice thing about this formula, though, is that it's easy to change the assumptions. What I just showed you here only applies to the case where we have compounding 4 times a year for 2 years and a rate of interest of 4% per year. For any other case, we have to do something a little differently. Whereas here, the nice thing about a formula like this is you can easily change the compounding frequency, you can change the time, you can change the rate. You can use this formula to calculate any future value you need based on how much you have now, how often the interest is compounded, what the rate of interest is, and how long the money will be in the account. Now, what does this have to do with E? Well, we'll find out in a second. If I increase the compounding frequency to 12, meaning once a month, this is what changes the N's. I've got N is 12. So I'm basically getting 1/3%. Oh, and this is a typo, by the way. This should be 00333. Okay, that's better. 24 times because there's 24 months in 2 years. So with monthly compounding, we end up with $1,083.14 instead of the original $1,082.86. So it's a little bit more. It's not a lot more, but it's enough. In other words, if somebody offered you the choice of those two amounts, you would certainly always take the 1,083.14. Now, this raises an interesting question. Why do we get more money with monthly compounding than quarterly compounding? Well, what we're going to do now is make a distinction between two important types of interest. We have simple interest, which is interest exclusively on the principal. And then we have compound interest, which is interest on interest. So in our quarterly example, remember with quarterly, we ended up with $1,082.86. $80 of that is simple interest. Why? Because we earn 4% for 2 years on $1,000 principal. So $80 is paid to us based on the principal only. The rest, the remaining $286, is the compound interest. What's happening is that we're being paid interest during the year, which is based on our principal, but also the interest we've accumulated up to that point. Now you can see the simple interest is much larger than the compound interest, but that's only because this is a short time frame. If we leave the money in the bank long enough, eventually the compound interest becomes greater than the simple interest. Now, when we did quarterly compounding though, I'm sorry, monthly, remember the future value went up to 1083.14. Well, the $80 in simple interest never changed. The rest, the remaining 314, is the compound interest. So you can see what's happened here between monthly and quarterly compounding. The only difference is that with quarterly compounding, we have 286 worth of compound interest, and with monthly, we have 314. That's where the difference is coming from. And that's the result of more frequent compounding. So in general, the more I compound my interest, the more often I do, the more I'll end up with at the end of the time period, because I'm getting more compound interest. So you might ask yourself, well, what happens if I have daily compounding? Will this go up? Yes, it will. What if I have compounding every hour or every minute? The compound interest will continue to rise, but it turns out there's a limit to how far the compound interest can go. And if you've had any calculus, you'll see that what we're going to do is take this expression and we're going to let n approach infinity, meaning an infinite number of compounding periods per year. And that reduces to this formula, PE to the RT. Okay, so in other words, the limit of this formula is PE to the RT. So I can use this formula to calculate the future value of my sum when interest rates are compounded, let me put this in quotes, continuously. Compounding takes place continuously, meaning at every instant in time. So in other words, it's like, imagine that you have an infinite number of interest payments. And so if I plug in the same exact numbers, I end up with 1083.287. It's just a hair under 29 cents. So if you compare this to the other two, you'll see that even with continuous compounding, it didn't go up a whole lot compared to the other assumptions. In fact, let's look at a summary of these. And by the way, if you never had any calculus, don't worry about it. All you need to remember is that if you continue to increase the compounding frequency, eventually the compounding will be continuous and you'll end up with this formula for your future value. So we have quarterly, 1082.86, monthly, 1083.14, continuous, 1083.287. So the gap between them comes down to the simple interest, a compound interest. In fact, probably should have made another column for that. All right. So what I'd like to do is just add down here compound interest, which would be 260, 314, and 3.287. So yes, as you increase the compounding frequency, the compound interest is going up, but it's actually growing at what we would say is a progressively decreasing rate. In fact, if you did this enough times and plotted it out, you can see that we reach a limit where that dashed line is. That's our continuous compounding. All right, so that dashed line here is continuous compounding. And then the others could be, for example, maybe this is daily, this is monthly, this is quarterly back here, and you can see it goes up, but it increases very slowly. And in the limit, we have continuous compounding. So the E is used in this example to calculate for us continuous compounded. Actually, what it's doing is calculating the future value with continuous compounding. Okay, so the bottom line here is that E is being used to compute the future value of a sum when rates are compounded continuously. In other words, an infinite number of times per year. Okay, now it turns out that in many cases, we may need it for a different purpose. So let me show you a couple of examples of this. Suppose instead of computing the future value of a sum, we are interested in computing what is called the present value of a sum. So let me show you what that means. For example, if we are saving for a car, and we can earn, let's say the car costs $25,000. And we can invest our money in a bank that pays 3% per year, compounded continuously. Now, in practice, banks don't typically pay compounded continuously, but daily compounding is pretty close, and that's what most of them do. How much must we save today to reach our goal? Okay. Well, what we're being asked to do here is, what is the present value of $25,000 received in, oh, I almost forgot. I forgot to mention the time frame. Let's say in 5 years. That might help. Okay. In other words, what is the present value of $25,000 received in 5 years? Okay, now we can do this with different compounding conventions, but I'd like to show you the specific case of continuous compounding, because that's what we're going to need in this chapter. So remember the formula we used for the future value. Okay, so the future value formula, FE equals PE to the RT power. All right, hold on. It's kind of awkward to make superscripts in PowerPoint, but we can do it. All right, the present value is basically just the reverse of this. All right. The present value, which we abbreviate PV, would be FV E to the minus RT. Actually, you know what? Let me do this. Let me change this to PV, because PV is what we're saving today. So E to the minus RT okay, so those are just inverses of each other. And in fact, as it turns out, we'll be seeing this formula probably more often in derivatives pricing models than this one. So in our example, what we can do is say, all right, well, if we want to save 25,000 and we need to have it in 5 years. So remember, in our case, the future value is 25,000. The rate is 3%. The time is 5 years. So we'll use this formula. And so here's what we're going to do. Yeah, this is very, very annoying. I find, except for whatever reason, PowerPoint makes it incredibly awkward to deal with superscripts and subscripts. Word is such a breeze, and Excel too. This is just a nightmare. You just playing games with it. Sometimes it lets you do it, and sometimes it doesn't. And unbelievable. Yeah, it's just unreal. Yeah, sometimes it cooperates, and often it does not. All right, you know what I'll do? I'll just write it by hand. It's going to be such a pain. Equals 25,000 e to the minus point. Oh, I forgot to write down. No, I didn't. You know what I did? I made a typo here. This is 03. All right, so the minus r is minus 0.03. The time is 5 years. And so whatever this amount is, this is how much we would have to save in order to reach our target with that car. And that works out to be 21,000 517.70. Okay. All right. So that is what we would call the present value of the 25,000, meaning I have to save that much now in order to have my 25,000 in 5 years. We also think of it as the present value. And so in other words, imagine if you were, I don't know, let's say you were paid for a project that you worked on and you were given 2 options. You were told you could get paid $21,517.70 today, or $25,000 in 5 years. Well, under these conditions, in principle, you would be indifferent between the two. I mean, if you were going to save the money anyway, either way, you're going to wind up with $25,000 in 5 years. So present value is used to essentially compare the values. Well, I guess technically both of them, present and future value, can be used to determine the values of cash flows at different points in time. Okay, in particular, present value can be used to compare cash flows on an equal footing, regardless, of when they are received. Okay, beautiful. All right, so now we can get back to our discussion about derivatives, because you're going to see these continuously compounded cases on a regular basis. So let's get back to the case of the gold forward contract. We did say earlier that with a forward contract written on an asset, that does not provide any cash flows to the owner, the relationship looks like this. The price, the forward price that you agree to in the contract is itself the future value of the spot price invested for T periods at interest rate R when the interest rate is compounded continuously. All right, so let's look at an example of this. It'll be so much easier than trying to explain it in English. Suppose that at the moment, gold sells for $1,500 an ounce. Now, this R, by the way, is understood to be the risk-free rate of interest. We'll explain that in a minute. That means it's the yield on a treasury bill. In this case, a 6-month treasury bill. The contract matures in 6 months. And so we want to know, what is the implied 6-month forward price of gold in this contract? All right, so we plug these numbers in. The spot price of 1,500. The time frame is 6 months or half a year. The interest rate is 6%. And when you plug them in, you can see that the implied forward price of this gold is $1545.68, which is the same thing as saying that if you sold your gold for $1,500 and put it in a bank account that pays 6% for half a year, when rates are compounded continuously, at the end of those 6 months, you'd have $1545.68. So that means that the forward price in this contract will be $1545.68. So the forward price is the future value of the spot price. That's what they're telling us here. All right, so that's the way that you have to remember it. The forward price, or the price at which you can take delivery in the future, is the future value of the spot price. Okay, so now let's see, down the road here, we're going to show all right, the reason for this, and I'll just throw this in here, and we'll discuss this more as we go along, is because at any other forward price, there will be arbitrage opportunities. Now, an arbitrage opportunity, and we're going to see a lot of that in this course, arises when it is possible to simultaneously buy an underpriced asset and sell an overpriced asset. Now, in other words, you're making money by buying something that's underpriced, selling something that's overpriced, and you put the difference in your pocket. Now, in principle, this should never happen. Okay, so the difference is known as an arbitrage profit. This should never happen in an efficient market. But of course, markets are not perfectly efficient. So sometimes this can actually happen. Now, let's just go back and visit this case. Okay, so for example, we've seen that, okay, let's repeat this information here. With a spot price of gold of $1,500 an ounce, a risk-free rate of interest of 6% per year the implied 6-month forward rate or price of gold is 45.68. Okay, now here's what we want to do. Let's do a thought experiment and see what would happen if the forward price was different. All right, so let's try this one. Suppose that a dealer offers a quote of F equals 1550 per ounce. Okay, in other words, this quote is too high to be consistent with the formula here it is, this formula. So why does that matter? Who cares? Oops. Well, here's what's going to happen. So imagine you are a dealer, a gold dealer. You buy and sell gold on a regular basis, and you want to enter into a contract with, let's say this is an investment bank. And they say, and to your great surprise, they say, well, listen, we'll enter into a forward contract with you where the gold price is $1,550 an ounce. So here's what you would do. And this is, by the way, this is for 6 months. So an arbitrage profit could be earned by, so here's what you're going to do. You're going to borrow dollars today, buy gold in the spot market, enter into a forward contract, a 6-month forward contract to sell the gold, and then in 6 months repay the loan. Okay, so let's see what happens if you do this. All right, so today, all right, let's see. Today, let's say you borrow $1,500 for 6 months. Now, by the way, this is assuming, this simplified version that I'm showing you assumes that we can borrow and lend at the risk-free rate of interest. If not, we have to make some adjustments, but this will illustrate the basic principle. So we're going to borrow $1,500 for 6 months at R equals 6%. Number one, use the proceeds to buy gold, okay, at $1,500 an ounce. 3, enter into a forward contract to sell the gold for F equals 1,500. Did I say 1,550? And then step 4, we're going to repay the loan. Well, I ran out of space. It's going to go in the next slide. Okay. So we have to pay the money back. We're using borrowed money here. We borrow $1,500 for 6 months at the rate of 6%. We buy the gold. We enter into a forward contract to sell it in 6 months for the price they gave us, which is $1,550. And then in 6 months, sell gold for $1,550 and repay the loan. Okay, so remember, we bought 1 ounce of gold and we're using that to deliver through the contract for $1,550. The loan will cost, and so remember, we're using continuous compounding. 1,500 E 0.06 times 5.5 equals 1545.68. Well, of course it does, because that's what we saw as the forward price, the correct forward price, 1545.68. So therefore, our profit is the difference between the 1550 rather, and let's see what that turns out to be. Approximately $4.32. Now, this profit is considered to be risk-free because we didn't use any of our own money to do this. And the price that we locked in is guaranteed. So we're able to take advantage of a mispriced forward ounce of gold. The missed forward price of gold is incorrect. We were able to take advantage of that and put a risk-free $4.32 into our pocket. So this is what we mean by an arbitrage opportunity. It only came about because of the inefficiency that was presented when the dealer gave us a quote that was incorrect. In other words, it did not match up with this formula. Only when this formula is used, and you can see, like here, remember we saw that with the correct formula, the forward price is 1545.68. If we went through these strategies with the correct forward price of 1545.68, we would have simply broken even. But because the quote we were given was a little too high, we're making a risk-free profit of 432. And so this is what arbitrage is all about. Now, so to summarize this a little, an arbitrage opportunity or this is a risk-free profit, is what I should say, because it is financed with borrowed money. The future returns, or the future price of gold, is locked in with a forward contract. The loan, cost of the loan, is locked in. And so the profit equals the difference between the future price of the gold and the cost of repaying the loan. And it's guaranteed. We're done. There's no potential way except, all right, now here's where there might be a bit of a problem: the credit risk. If we enter into this contract with a financial institution that goes out of business, well, then that changes everything. But if failing that, you can see we've locked in a profit. Okay. Now, if the price is too low, if F is too low, We can also earn an arbitrage profit, although we have to go about it in a different way. All right, so I guess we could go through this. This one's even more complicated though, but I guess we can run through it. So let's just say that this time the price is only $15.40. Oh boy, the quote is too low to be consistent with this formula. So what do we do about it? So we basically have to go in the opposite direction. So what we're going to do is we're going to, let's see, what's the best way to explain this? We're going to short sell an ounce of gold. Now, what is that all about? Short selling means that you're able to go to a broker and you're able to borrow something you don't own and sell it and promise to repay it in the future. So if you short sell an ounce of gold and collect $1,500, invest the $1,500 at the risk-free rate of 6% for 6 months. Enter into a forward contract to buy the gold for $15.40. Okay, and then at the end, you have to replace the gold that you short sold. So in 6 months, replace the gold that was short sold. Okay, so then what do you do? So here we're gonna run through this real quickly. So we short sell the gold. And again, you notice that we're assuming that this is possible. And collect $1,500. Now let's assume that when you return the gold, you have to pay interest on it. 6% for 5 months. Invest for 6 months at, was it 6%? Enter into a forward contract to buy gold for $15.40. Okay. And then in 6 months, return the gold. So how is this going to help you? All right. Okay. So let's say we have to create a timeline for this. So today, okay, and then we enter into the forward contract. All right, so what's happening here is that we don't actually take any money out of our own pocket. So what has to happen in 6 months, what we will do is collect the proceeds of our investment and by that I mean 1,500. And how much interest do we earn? Well, you'll recognize this right away. That's going to be worth 15.4568. Okay. Now, here's the thing. Use 1540 to buy 1 ounce of gold with the forward contract. Remember, we're committed to that. We entered into a contract to buy gold for 1540. And then what we have to do is use this ounce of gold to return it to the broker who allowed us to short sell it 6 months ago. In other words, we owe, when you short sell, you have to bring it back. You're basically borrowing something and then selling it with the promise of bringing it back. So we brought it back. So, so the $1,500 that we collected when we sold it was invested, and it brought us back 1548.68. In the meantime, we were able to lock in the price of gold that we were able to buy 1540 in 6 months. We do that. And so what happens is we collected 1545.68 from our investment. Paid 1,540 for the gold. Well, I think you can see where this is going. The arbitrage profit is $5.68. Because we were given a quote that was too low, we were able to earn an arbitrage profit. So what is all of this telling us? All right, you don't have to know all the gruesome details, but what this is saying is that using this formula, if let's see. If the quoted forward price is higher or lower than this formula, then an arbitrage profit can be earned. And by the way, in the process of exploiting this, the prices of S and F adjust until the relationship holds again. So therefore, this formula is known as arbitrage-free pricing formula. Okay, because this is the only price of F at which no arbitrage opportunities can arise. All right, so we often see in the derivatives markets, these pricing formulas are called arbitrage-free formulas, which simply means that if they're violated, then investors will be able to earn risk-free profits through arbitrage, and the prices will adjust themselves until pretty quickly they will hold again, or at least this relationship will hold again. So if the market is somehow inefficient enough that somebody gives the wrong quote for F, other investors will jump in and they will take advantage of it, and pretty soon S and F will be in the right relationship again. So this formula you're seeing here is not just any formula, it is our first what we call arbitrage-free formula. And you can see why it's so important now, because it's the only price at which there are no arbitrage opportunities. And so virtually all derivatives and pricing models are arbitrage-free models. And that's why they hold with mathematical precision, because markets are quite efficient. So now you may have run into other types of relationships in the past. You may have heard of the concept of equilibrium. Let me just throw that in here as well, because we'll see this later on. An equilibrium relationship, such as the one between supply and demand, can be violated for short periods of time, but there is a tendency for equilibrium to be reestablished. Oh man, when this happens. However, there are no risk-free profits available when a market is not in equilibrium. Okay, so it's not the same thing. So if you see a market, there's a market where, let's say, the quantity supplied is greater than the quantity demanded, that means the market is not in equilibrium, but that doesn't mean that there's an arbitrage opportunity for you. With these type of formulas, these arbitrage-free relationships, then any deviation, even by a penny, implies that there is an arbitrage opportunity available. So that means that these are not likely to be violated in practice. All right, then. So finally, with all that out of the way, now the reason why that was important to go through now is because we're going to see this over and over again throughout the course. Two things actually, two very good things came out of all this. Number one, the idea of continuous compounding and how it can be used to calculate present and future values, number one. And number two, the whole idea of arbitrage. Those two concepts will show up in just about every model that we look at throughout the course. So this is as good a time as any, I think, to learn about these ideas. And when we see them again, they'll make a lot more sense. All right, so we got all that out of the way. So now we can focus on these models again. Now, here's a case where there actually is income being provided to the owner of an asset. Oh, actually, no, sorry. This is just another example of a no interest situation. This is a 3-month forward contract on a stock that pays no dividends. So there's no income being generated for the owner. It's just, I mean, they're hoping that the price will go up, but we're not getting dividends, let's say. So the stock is selling for $90 a share, and the risk-free rate is 5% compounded continuously. So the forward price, and by the way, we're assuming that 3 months works out to be 0.25 years. We're sort of glossing over the number of actual days in the year being, obviously 365. So just to keep it a little simple, let's just assume that 3 months is exactly 0.25 years. And so in this case, the correct forward price for this stock is $91.13. Okay, that is the no arbitrage relationship, which means that if you get a quote from a dealer for some other number, then you'd be in a position to take and earn risk-free arbitrage profits. Now, and also if you notice, very simply, I mean, it sounds like it's very complicated, but the reality is all they're telling you is that the the forward price today at time zero is simply equal to the future value of the spot price. That's all it is. And so if you wanted to enter into a contract to buy the stock in 3 months for $90, well, actually, no, if you want to buy it in 3 months, you would pay $91.13. In other words, it's selling for 90 now. But what if you don't want to buy the stock for 3 months? You would then say, all right, what price can I lock in 3 months? And the answer would be 91.13. Okay. All right. All right. Now, what about now we're looking at the case. Now, there's two different ways, by the way, we can have income. We can have lump sum payments on an irregular basis, like coupon payments on a bond, which only occur twice a year, or dividend payments to a stock, which only occur 4 times a year. That's what we're seeing here. The other alternative is, let's say you own a foreign currency like the British pound, and you keep that pound in a British bank account. The interest that they're paying you is typically compounded on a daily basis. Now, daily is not the same as continuously compounded, but it's really, really close. So in a case like that, we're going to use a different approach to pricing or figuring out the forward price. Here, what we've got is a new term, and that and by the way, this is a bond that makes discrete coupon payments. Semi-annually is typical in the United States. What we will call coupon payments, which are it's just another name for interest payments. This I is the present value of all coupons that will be paid during the lifetime of the contract. So let's say this is a 6-month forward contract. I represents the present value of all the coupons that we will receive during those 6 months, which could be 0. It depends on the time frame. So if you notice, this is actually reducing. This I here reduces the forward price. Okay, if you notice, that makes the forward price lower. Now, you're probably wondering why. Well, I'll tell you why. Here it is. Keep in mind, a forward contract can be thought of as an alternative to borrowing and buying an asset and holding it until the maturity date of the forward contract. All right, so in other words, if I really was worried about the price of gold, and I mean earlier, remember what I did? I bought the forward contract, but I could have borrowed money and bought gold today and simply held on to it for 6 months as well. So the cost, or I should say, in order to avoid arbitrage profits, the forward price of the asset must equal the cost of borrowing, buying, and holding the asset, because they are basically the same thing. So in other words, the two of them, it's really the forward price simply reflects the cost of borrowing money, buying and holding the asset. Does that make sense? In other words, it's just an alternative. It has to cost the same, otherwise there would be an arbitrage opportunity. Now with the gold was not giving us any income. We bought the gold, we left it in our safety deposit box, I guess, and we held it until the date that we actually needed to use it. The forward contract would therefore reflect the cost of doing that. Okay, the forward price, I mean, would reflect the cost of doing that. But if the asset provides income, okay, so this is the interesting part. If the underlying asset provides income to the owner, then holding a forward contract means that the owner is not receiving this income. Therefore, this reduces the forward price to reflect this. How do I put this? The forward price must reflect the disadvantage that the owner does not receive the cash flows from the asset. Or another way of thinking of it is that the assets, the cash flows to the asset reduce the value of the forward contract, and therefore the forward price. I think that's probably better. In other words, anything that makes holding the asset more attractive is going to reduce the attractiveness of the forward contract, and therefore that will make the forward price lower. Okay, so let's look at an example of this. Now we have to be careful with this, with the timeline. So I've drawn a little timeline for you there. A treasury bond will mature in 15 months. It pays, and to keep it simple, let's assume that its coupons are paid annually, 5% per year. The next coupon is due in 3 months. The face value of the bond is currently $1,000, or is $1,000, and the market price is $1,020. So what this means then is that if you bought the bond today times 0, you'd pay $10.20 for that bond. In 3 months, you'd be entitled to collect the payment, the coupon payment of $50. A year later, you would receive the full face value to that bond of $1,000 plus one final coupon of 5% or $50. Okay, great. So those are the cash flows in the top. Now, the interest rates, though, you have to be careful with this. Assuming that these are continuously compounded rates of interest, we're going to assume that the 3-month rate is 2.5%. Now, here's where we have to be careful. 2.5% means per year or per annum, PA. If you invested at this rate, you're only going to get a quarter of that. So keep that in mind. We're also assuming that the 6-month rate is 3%. So here's the twist. The contract specifies that we can buy the bond in 6 months. Okay, in 6 months. All right, so let's see if I can maybe put another diagram in here. this is when the contract starts. And so when you enter, if you choose to, I mean, when you buy this bond with this contract, you're actually getting a bond that has 9 months left to the maturity date. So you're effectively buying a 9-month bond. So if that's the case, keep in mind that you're going to collect one coupon of $50. Let's see. So what we need is the present value of that $50 as of this time right here. Now, let's see, what do we do here? Let me just double check something. So this is the 3-month. 3-month rate is 2.5%. And the 6-month rate is 3%. The contract begins in 6 months. So we want to know what the bond's price will be in 6 months. Or in other words, F. So the formula we saw is S0 minus I E to the RT power. So the first piece of business is to figure out I. All right. So what we need is the bond's price. The bond will pay at 50. Wait a minute. I equals, oh, I almost forgot to write down the formula for I. I equals the coupon payment, E to the minus RT. T is the coupon. So from today's perspective, the coupon of $50, the next coupon is $50. It will be received in 3 months. The 3-month rate is 2.5%. The time is 0.25. So in other words, if I were going to receive a $50 coupon in 3 months, today it would be worth to me 49.6885. By owning oh, and the market price is still, you know what, I almost forgot. This S0 is this market price of 10.20. That's what the bond is selling for today. Okay, so what that means then is that in the next slide, you'll see that we have the current market price, the present value of the next coupon, and whatever that is, the forward, what we're doing here is calculating the future value of all this. And what we're basically doing is projecting this 6 months into the future, because that's when the contract will start. And so therefore, the forward price of the bond that will be delivered in 6 months is that number. In other words, if we want to take delivery of this bond in 6 months, we will pay $984.9759 at that time. All right, so in other words, that's what determines the value of this contract. We basically are entering into a contract that gives us the right to buy this bond in 6 months for $984.9759. Now, whoever buys it will be entitled to receive in 6 more months, or actually 9 more months, this $10.50. Okay. So this is a good contract to reduce interest rate risk because you're locking in the price at which you can buy a bond, not today, but in the future. Now, that's a very awkward formula to work with, as you can obviously tell. Most of the time, financial assets can be thought of as have what's considered to be a continuously compounded rate of return. Like I said, a currency that where the interest payments are based on maybe daily compounding, but that's awfully close to continuous compounding. So here you can see the formula is much more convenient. In the exponent here, we have the domestic, this is the risk-free rate of interest. This is the return or yield of the underlying asset. And this difference can be, R can be greater than Q, Q can be greater than R. So this exponent can be either positive or negative. This is the one we're going to see the most often. And this one is perfectly suited for pricing or determining the forward price of currencies. All right, and that's exactly what we're going to do here. We're going to see how this would apply to a currency. Now, if we do apply this to a currency, Q would be the foreign rate of interest, and R would be the domestic rate of interest. Okay, so if we're using it, now, by the way, there's other things we could do with this. For example, what if the asset that we're delivering is an index on a stock or stock index like the S&P 500, then the Q would be the return to the dividend yield on that portfolio. But much of the time, this formula is used for pricing or calculating the forward price of currencies. All right, so here's a good example of this. So the spot exchange rate between the dollar and the pound is currently $1.80, let's say. The US risk-free rate is 3%, and the UK risk-free rate is 5%. Those are treasury bill yields. The price of a 6-month forward contract on the pound is computed as follows. In other words, if I want to enter into a forward contract to buy British pounds in 6 months, what would be the arbitrage-free forward exchange rate? Well, let's find out. So we plug in the numbers. And remember, this is the US rate. This is dollars per pound. As is this. This is the US rate. This is the UK rate. And by plugging them all in, all of this reduces to negative 0.01, $1.80 times e to the minus 0.01 gives us a forward exchange rate of 172.82. So by buying them in 6 months, they're actually a little bit cheaper than buying them in the spot market. And that's the exchange rate I can lock in with a forward contract. And so this is how I might want to hedge my foreign exchange risk. All right, so now this relationship, when we're using it for currencies, is often referred to by a special name. It's called interest rate parity. So if you see that phrase, it means this formula where S is an exchange rate, and so is F. It's heavily used in the financial foreign exchange markets to determine how much the forward exchange rate should be. All right, so now I've got a nice little chart here that helps us summarize how forward prices are determined depending on what the asset does, whether it pays income, no income. So let me show it to you real fast. All right, no income is the first one we started out. The known income, now here, I guess, think of this as a lump sum income, meaning that we get paid once in a while, like twice a year, 4 times a year. The last time, we're using the word yield here, but this implies that Q is a continuously compounded rate of return. So these are the three main ways we can calculate forward prices, and they're all arbitrage-free relationships. All right, so that's that. Now, what we're going to do next is revisit futures contracts, which, as you recall, are very closely related to forward contracts. Yes, they are, but there are some important institutional differences. And what that does is it drives a wedge between forward prices and futures prices. They aren't necessarily equal to each other, although the differences can be very, very small. These are a little bit more down to earth. It's easy to prove that these are no arbitrage prices. The futures contracts are trickier because of the market-to-market feature. That does make things a little bit more challenging. So we're just going to basically talk about the general differences between the forward prices and the futures prices. All right, just bearing in mind that they're going to be very similar to each other. All right, so you know what, since we're starting a kind of a new topic, I guess right about now might be as good a time as any to have our evening break. We'll come back in about 15 minutes or so, and when we get back, hopefully fully refreshed, we'll spend a little bit more time here with futures contracts. And then, of course, well, let's see, what else are we going to do here? Oh, no, I think we're moving along pretty well. I was afraid we might fall behind because we had all those wonderful examples of what arbitrage means. But no, I think we're in pretty good shape here. And I think the math burden will start to shrink just a little bit too. But, you know, sometimes it's really important. Yeah, the rest of it is a little bit more conceptual, I would say, except, ooh, okay, well, I don't know. All right, I think we'll be okay. All right, we'll survive. All right, so see you all in about 15 or 20 minutes. All right.
Professor,
Oh,
I'm
yes.
sorry. For our assignment, when is it usually due?
I forgot which one, what we had to do this week.
The first one.
Oh, no, usually I would prefer that you send it in by the following week. Like,
So the assignment number one is due today, or
but you know what, if it's not quite ready, you can have a few more days, but just keep it as a rule of thumb. Think of it as being due the following week, but you know, we can have a little slack in there too, because I know you all work full time and all. So it's not that rigid, but you know, ideally it should be ready by the following week.
by the following week? Oh, okay. And also, if you don't mind, could you send a syllabus?
Oh, did I? Oh, Christ. You know why I forgot? Because they send me a huge list of all these little, tiny little changes they wanted me to make, and I just forgot all about it. So I'm glad you reminded me. I will write down right now a little note to myself, which says, don't forget the NYU syllabus.
No problem at all. Thank you so much. Appreciate it.
And of course I can't find, oh, here it's one. Yeah, let me make a note to myself. No, absolutely. They were supposed to be ready last week. So, but they asked for all these last minute changes. That's what held it up. So I haven't changed it very much, but they changed the format for some reason. And so it's not as simple as just sending you a new one, an updated one. I have to go make sure I follow what they did. So I'll have that as soon as I can. All right. Anything else?
All right, no problem. Thank you.
All right, good. All right. I'll see you all in a bit.
All right.
All right, so I guess we're ready. So futures contracts, we've already seen some of this before. Some of the main differences. Forward contracts are, of course, negotiated directly between counterparties. For example, if General Motors needs to buy British pounds in the future, they would approach an investment bank most likely, and they would negotiate a contract. And then we call this sometimes the over-the-counter market, where where counterparties negotiate directly with each other, as opposed to an exchange where we have an organized exchange that handles all the details. But here, this trading is taking place directly between the counterparties. And the futures contracts themselves are, of course, traded on exchanges like the Chicago Mercantile Exchange. That makes things a little bit easier in some ways, but in other ways, it makes things a little bit more restrictive, as we've seen. For example, with a forward contract, you can essentially have anything you want, as long as you can find a counterparty to trade it with you. Whereas with the futures contracts, you really just have to take whatever they've got that's available. But in exchange for that, what they do is they make sure that whatever contract you enter into is always honored, so there's no credit risk. Yeah, so as a forward contract is negotiated with a counterparty, there's always some default risk. Even the most prestigious investment banks can go out of business. Okay, it happens. It happened during the credit crisis of 2007 to 2008, when old-time brokerage houses or investment banks like Lehman Brothers and Bear Stearns did go out of business. And then some of the others were bought up by others, like Merrill Lynch was bought out by, if I remember correctly, Bank of America. So if you had entered into a contract with one of those organizations, most likely you would not have received whatever it is you wanted to do. So, so unlike with a forward contract, the performance of a futures contract is guaranteed by the exchange of which it trades. So there's no, for all practical purposes, there's no credit risk with a futures contract. Now, a futures contract is easy to unwind, as it's called, because all you have to do is enter into the opposite futures position if you want to close out your exposure to whatever it is you're buying or selling. Just as a quick example, imagine a situation, for example, if a corporation enters into a long futures contract on gold for delivery in December, the position can be unwound or offset by entering into a short futures contract, meaning that you're selling. The long means you're buying, the short means you're selling on gold for delivery in December. In other words, you're just basically taking the position, the opposite position in the same contract. So now, before you were committed to buying gold in December, now you also have a contract to sell gold in December. So the two positions exactly offset each other. And for all practical purposes, you are now no longer exposed to gold. Tactically, you have two contracts outstanding, but since their cash flows exactly offset each other, for all practical purposes, you have no position in gold at all. So this is easy. This happens a lot when somebody enters into this contract, and at some point they decide that whatever they were hedging is no longer relevant, so they can unwind the entire position by simply assuming the opposite position. And in fact, in a lot of cases, hedging is done this way with futures contracts because the hedger may not actually want to take delivery of the gold. They simply want to collect any profits that they may earn from their hedge. And so they'll wait until the timing is right, and then they'll offset their position with the opposite contract. Whereas with a forward contract, really none of this is feasible. It's not impossible, but it's not nearly as easy as it is with the futures contract. So when you enter into a forward contract, you're pretty much entering into a binding agreement, which is very hard to get out of if necessary. So if you need the flexibility, you might be better off with the futures rather than a forward contract. So because it's so easy to get out of these futures contracts, it turns out that actual delivery doesn't happen very often. And in fact, something like only 2% of all contracts actually result in delivery of the underlying asset with a futures contract. Whereas with forward contracts, almost without fail, the delivery actually takes place. So if you want to take the delivery, then you might be better off with a forward contract. But if you're simply hedging your position, you may be better off with a futures contract. And finally, with the forward contract, we have the dreaded marking to market, where we have to put cash into our margin account. And every day that goes by, we may have to put even more in there because our position may lose value. And this can actually prove to be very expensive, especially if your position is losing value. And in fact, if you're not able to keep up with the margin payments that you are required to put into your account, your position could actually be closed out by the exchange and you could end up losing money. So, this is something you have to keep your eyes on. This is a definite cost or potential cost of having a futures contract. What if you're required to put significant amounts of money in your margin account before the delivery date of the asset? That could potentially get very expensive. This process is called marking to market. And so what happens is we enter into this position with a futures contract. Each contract specifies how much money you must put into your margin account. Now, it's usually not a huge amount. Now, here's an example. Let's say that you enter into a futures contract on gold. Now, gold futures contracts typically are written on 100 ounces. So a single futures contract is actually giving you the ability to buy 100 ounces of gold, not just one. And so at current prices, 100 ounces at, let's say, $1,500 an ounce, that could really be expensive. That means the underlying gold in your position is worth $150,000. So what if they ask you to put into your margin account, let's say $5,000? Well, that sounds like a nuisance, but that's really no more than about 3-4% of the value of the gold that your contract enables you to buy. So it's going to be a fairly small number, $2, $3, $4, maybe $5,000. Now, here's the thing though. Once the money goes into an account, it doesn't just sit there. If your position loses in value, you may have to add more money to your position. And if you do, we call that extra margin variation margin. Now, why are they doing this, by the way? Because the exchange is on the hook for any losses you may suffer. So they don't want your losses to pile up over time. So what they're effectively trying to do here is figure out the maximum amount you might realistically lose in a single trading day. And if you can't put up the margin that you're required to put into your account, then they'll just close out the account. And so potentially they're only exposed to a maximum loss of 1 day's worth of trading for each contract that trades on their exchange. So they're trying to keep the losses down to a minimum. In other words, they don't want to cover enormous losses that you've racked up over several months. They're in effect trying to keep your losses limited to 1 day. If you can cover your losses with more margin, that's fine. But if you can't, then you have to stop trading. Okay, you're out. That's it. They're going to close you out, and that's the end of it. So here we go. So here's a British pound futures contract that trades on the Chicago Mercantile Exchange. And these are the actual, I think we looked this up last time, but these are the terms and conditions or specifications. And so you can see up here on the top, a single contract controls 62,500 British pounds. Now, where in the world they came up with that number, I honestly don't know. If you want to enter, by the way, into a futures contract with a smaller amount, you might be able to find it on a different exchange. The Philadelphia Stock Exchange actually trades in currency options, I believe, and possibly currency futures, and they tend to have smaller amounts in their contracts. In other words, let's say if maybe we should look this up real fast. What kind of foreign exchange futures available on the Philadelphia Stock exchange. Oh, that's CME. No, I meant, here it is, here it is. Oh my, they changed I did not know about this. NASDAQ bought them out and changed the name to the NASDAQ OMX PHLX. And it's now, oh, I guess they only do options now, huh? How do you like that? Well, I did not know that. All right, well, then somewhere out there might be another exchange that has smaller contracts. In fact, even the CME itself has these new style contracts. On stock index futures, they have what are called mini future contracts, where the amount that you are buying is smaller than a traditional futures contract. I don't know if I can find one or not right now. Let's just check this out really quickly. Dow Jones mini futures contract. Let's see what it has to say. E-mini Dow futures contracts, yes. These E-mini products allow you to short the index without stock loans, okay. Oh, and they even have something called micro. Oh boy. So I'm guessing that these are simply designed to make it possible to buy a contract with a smaller underlying asset. So here we go. Meet the micro E mini futures on the S&P 500, the NASDAQ 100, Dow Jones, and Russell 2000, 1/10 of the size of the classic, oh my God, E minis. Well, the minis themselves were a tiny percentage of the original futures contracts. So these things must be really small. Oh my God. I wonder how many. Oh. Well, it doesn't say here exactly, but the reason for this is because it's easier for investors to or hedgers, because they may not need such large amounts. I mean, who needs 62,500 pounds? I don't know. What if you only have an exposure of 10,000 pounds? What do you do? Well, I guess you turn to the forward exchange market, but that's a lot of amount. That's a lot of pounds, and that's the traditional amount they've always had. So these are really tiny contracts, but I can't really tell from here how large they are. Like here, for example, the micro E-mini. Oh, I think I see what they're doing. The Standard & Poor's 500 index futures contract is basically based on 250 times the value of the S&P 500. In other words, that's what the price is. Take the Standard & Poor's 500, multiply it by 250. That's the futures price. Here, instead of 250, it's 5. So these enable you to buy futures contracts for very small amounts. Why do you suppose they're doing this? Well, because they're more flexible, but because it means you can also attract a lot of smaller customers. And I mean, these exchanges, they make their money through volume. Volume is what they're after. So that's how they make their money. Interesting. So minis and micro minis. Wow. Huh. Look at this, for the Dow, it's 50 cents. All right, well, anyway, let's get back to this. This is the standard traditional British pound futures contract trading on the CME. Now, the price changes have to be at least 1/100th of a cent per pound, which works out to $6.25 per contract. The delivery months are only available in March, June, December, September, December. And you can see there is not much flexibility here. Let's see. All right, this we know. Oh, yeah, and this is a deliverable contract, which means if you hold it to maturity, you'll actually take possession of 62,500 British pounds. A lot of these futures contracts are cash settled, which means you're not collecting the actual asset, you're just getting money. And that makes sense for certain types of contracts, like a contract in the S&P 500. You're not expected to take delivery of 500 stocks. It means you're going to get cash. But for many of these futures contracts, you're actually still collecting the underlying asset. All right. Now, marking to market. Let's see how this actually works. An investor takes a long position in the September British pound contract based on 62,500 pounds. And let's say the September price is $1.26 a pound. All right. Now, let's say that the initial margin is 1650 and the maintenance margin is 1,000. That means that you start out with 1650 in your account. If the balance falls below 1,000, you not only have to replace that money, but you also have to bring your account balance back up to 1650. Okay, so yeah, you got to be careful. And so you're going to deposit the funds with the CME. Now, here's an interesting side note. It sounds like there's going to be an opportunity cost here. You're putting money into this account that could have been earning interest in some other investment, but they allow you to deposit treasury bills instead of cash so that you're still earning interest. So that helps reduce the cost of having a margin account. You can actually use treasuries instead of cash. Now you might think, well, 1650, that's too small for a treasury bill. No, it used to be the case that treasury bills had a minimum investment that was quite large, but now it's gotten to the point where treasury securities can be had for as little as $100 by going directly to the government's website, the US Treasury's website. And that's because they want to appeal to smaller investors and say, listen, the days when you had to have at least $100,000 to buy a treasury bill are over. These days, you can buy a treasury bill for only $100 because we know there's a lot of small savers out there who may very well want to buy one of these. When you have to borrow as much money as the US government, you have to make it convenient for your potential investors. You can't just scare them away by requiring a minimum investment of $100,000, okay? So now pretty much all the treasury securities out there can be bought for as little as $100. Now, by the way, because it's this contract is based on 62,500 pounds, a 1 penny change in the exchange rate is actually going to change the value of your position by $625 US. All right, and by the way, too, if the balance in your account goes up above the initial margin of 1650, you can actually take it back right away. You don't have to leave it there. As long as your balance doesn't fall below the initial margin of 1650, you can just withdraw it, okay, all the way down to 1650. All right, but now, of course, if it goes down by a penny, you're losing $625. And remember, that's not much because the initial margin was 650, the maintenance margin is 1,000. You don't have to lose a whole lot for that margin call, like just slightly over a penny. And you know how volatile exchange rates are. It's not that unusual for exchange rates to move by more than 1 cent during a given day. It happens all the time, as a matter of fact. In fact, I mean, like the British pound US dollar exchange rate has gone through a lot of gyrations in recent history. In fact, why don't we take a quick detour and we're going to go to a very excellent source of financial data called FRED. And FRED stands for Federal Reserve Economic Database. And they have a lot of economic data, of course, and here it is, of course. This is what I figured. So this is the exchange rate. How many dollars does it take to buy a pound? And you can see right now that's in the neighborhood of about $1.35, let's say. Now you can see that we've had some ups and downs here. Now look at this. Sometime in the beginning of 2020, now that would be the COVID. Let's go back a little further here. Where else did it suddenly spike down? So I'm trying to remember when the Brexit was. Right about here, I think, was Brexit, or somewhere in this area. Brexit caused it to drop off pretty sharply. And then it bounced back up for a while. And then the COVID came along and knocked it down some more. But you can see it's going all over the place. I mean, April 20th, $1.50 roughly. Previous July, $1.71. So you can see it goes all over the place. And if you look at the bigger picture, I mean, really, there have been times when the pound, somewhere down here, the pound was really close to a single dollar. Where is, oh, here we go. And yet way over here, we're talking about a 260. This is in the 70s, but still. So exchange rates go through a lot of gyrations. So it's not unthinkable that the exchange rate could change by a penny, and suddenly you find yourself with a margin call. All right, so just now here I have a numerical example for you. So you can see exactly how this works. All right, so imagine that we enter into this contract on day 0. The price is 126, the futures price. The margin balance is 1650. Now, the next day we lose money. We have a long contract, and how much do we lose? Let me just figure this out. 1.26 minus 1.2549. It's a loss of about 0.0051 cents. When you multiply that by 625, oh, and then times the 62,500, you're getting a loss. Wait a minute. Hold on a second. It's 1.26. It's about 0.005. All right, let me try that one more time. 0.0051, if you multiply that by 62,500, oh, here it is. You're losing $318.75. All right, now I get it. So in other words, if you multiply this price difference by 62,500 pounds, so we're down now. The maintenance margin is $1,000. So as long as we stay above that, we're fine. Now the next day we actually make some money. Wow, we're happy. So now all of a sudden we gain back what we lost, and then we make some more, bringing our balance up to 1868.75. But then the next day, ooh, it goes down again. And now, look where we are, 124.87. The margin balance dropped below 1,000. So we have to put enough money into this account to make sure that the total brings us back to 1650. And that means we have to deposit another 706.25 into this account to bring it up to 1650. And then the next day, we make money. Now this is relative to day 4, not to the starting point, but compared to day 4, we just made back about 1 penny and 1.03 cents. So our balance is now 22.9375. Now, if we wanted to, we could withdraw the surplus of that compared with 1650. All right, so in other words, 2293.75 minus 1650, we could actually withdraw 643.75 now if we chose to do so. We don't have to, but we can if we want to. And so this is what we mean by marking the market. And this happens every single day throughout the life of the contract. So again, it's really just a way to provide collateral to the exchange to make sure that their positions are safe. They don't want you to lose money and then they have to cover it. Okay. And by the way, I just want to remind you that behind the scenes, when I buy this futures contract, the exchanges matched me up with somebody who's selling, somebody who's got a short position. So if I lose, that means the counterparty to my trade is making money. And if I go bankrupt, well, that other counterparty won't be happy, will they? And so the exchange, unfortunately, has to step in and cover my losses. So anyway, so here I've got all the details. You know, you can go through these separately if you want, but I think we get the gist of it. So that's what we mean by marking to market. Now, what about spot and futures prices? Futures prices behave a little bit differently than forward prices because we don't have the same direct connection between spot and forward prices. The marking to market throws that off just a little bit. One thing we do know is that when the contract matures, the forward price and the spot price will exactly match each other. Because if they don't, here's another situation where arbitrage arises. So let me just sketch in there a quick diagram. That means that if hold on one second. Yeah, imagine the following situation. Whatever the asset is, it doesn't really matter. It's that'll be time. And let's just say that, and this is dollars. As of today, whatever today is time zero, here's the spot price. And here's the futures price. And let's say the maturity date of the contract is here. I'll call that capital T. And the spot price is here. It goes up and down and up and down, whatever. If the forward futures price is above it, it can stay above it, but it's going to gradually converge. And here they have to be equal to each other. If we had the opposite scenario, and up here it was the spot price and here's the futures price. No matter what happens to the futures price, eventually it has to reach this point and they have to be the same on that maturity date. And again, if not, there's going to be an arbitrage opportunity. And so we're going to see that how that would work. Okay, so imagine that on the final day of trading, the forward price is actually lower than the spot price. So they didn't quite make it. Here's F, here's S, and whoops, what happened? They're not the same. Well, here's what you could do to make an arbitrage. S is above T. Now remember, the thrust of arbitrage is that you're buying something that's underpriced and you're selling something that's overpriced. Here, the spot asset is overpriced. So you're going to enter into a long futures contract to buy the asset for FT dollars. Then you're going to take delivery by paying FT on the maturity date, that is. You immediately turn around and take that money. And remember, you just took possession of the asset, whatever it is. Let's say it's gold. Now, because this market price of this gold is higher than the futures price, we can sell it immediately for ST, which by assumption is greater than FT. And so the difference between the two is our profit, which is guaranteed to be positive. Oh, there you go. How do you like that? And on the other hand, What if it was the other way around? Somehow F never quite converged to S. Oops, on the maturity date, F is still above S. So we buy the asset, enter into a short futures contract to sell it for FT, deliver the asset for FT. And guess what? We're selling for a higher price than we paid for the asset. And our profit is FT minus ST, which is greater than 0. So any way you look at it, if the two aren't the same, we can take advantage of that and make a risk-free arbitrage profit. So you can rest assured that in an efficient financial market, this is what will happen. So the bottom line is, there they go. Okay, now this next part is a little bit tricky. The relationship between forward and futures prices. They don't have to equal each other. Now, here we're just saying that at maturity, the spot and the forward price are the same. But here we're asking the question whether the forward price of an asset equals a futures price. So imagine you're entering into a futures contract on the Chicago Mercantile Exchange to buy British pounds. Suppose you then turn around and negotiated a contract with Goldman Sachs to buy British pounds in the same time frame. Is it necessarily true that the two prices will be the same? And the answer is not necessarily. Okay. The futures price on the Chicago Mercantile Exchange and the forward price agreed to in a contract with Goldman Sachs, they could be slightly different. So the question is how and why. All right. And again, it's the marking to market that really throws them off from each other. Otherwise, they'd be identical. It's the marking to market that means that they may not be identical. So imagine this situation. Suppose that the futures price is higher. Or imagine this situation. What if there's a positive correlation between interest rates and the price of the asset underlying the contract? When that happens, the futures price will be higher. Now, here's why. By the way, before we do that, I just want to remind you what correlation actually is all about, because we're going to need it for our future discussions. If you had statistics, you know that correlation basically measures how closely two variables tend to follow each other. For example, if you look at a corporation's profits and their sales over time, it makes sense that the stronger their sales, the higher will be their profits. So you'd expect there to be a strong correlation between profits and sales. So there's actually 3 different types of correlation that we could encounter. First, we have 2 variables that are directly related to each other. Like I said, sales and profits. If you were to plot sales and profits over time, you can imagine yourself, let's say in this diagram, fitting a line through those points, and that line would have a positive slope. That tells me that the 2 variables are positively correlated, okay? Meaning that when X goes up, there's a strong tendency for Y to go up and vice versa. So the one that I thought of as sales and profits, it should be pretty clear that they would tend to be strongly correlated. On the other hand, what if there are 2 variables that tend to go in opposite directions? For example, profits and labor costs. As labor costs, or X, goes up, our profits tend to go down. And so we have a negative correlation between the 2 variables. When one goes up, there's a strong tendency for the other one to go down. Now, there's a third possibility too. 2 variables could be related to each other, in which case they're not correlated at all, like corporate profits and, let's say, the temperature. Unless this corporation is in the business of selling surfboards or something, there's chances are that their profits are not really related to weather. So the correlation is going to be essentially zero. Now, the way correlation is defined, the measure that we construct always has to have a value between -1 and +1. +1, well, this isn't this is close to +1. You can see this, the trend is very strong. We're not quite at +1, but we're getting close. Here it's the other way around. And then this one, the correlation would be roughly 0. Anyway, let's get back to this now. And by the way, so those are the 3 cases. And when it comes to investing in stocks, of the 3 cases, this is the one that helps us reduce our risk the most. If we have a negative correlation between the returns of our stocks, that means the risks are basically offsetting each other. And that's pretty much exactly what you want. All right, well, anyway, so let's get back to this. Now, as far as futures go, what if the futures contract is written on an asset whose value gains when interest rates go up? Well, that means when rates go up, your margin balance will go up too. You'll be able to withdraw your surplus and invest it at a relatively high rate of interest. When rates drop, okay, your position will deteriorate, and you may need to make a margin or meet a margin call, but you could actually borrow those funds at a relatively low rate of interest. So therefore, for a futures contract written on an asset with a positive correlation with interest rates, having a futures contract would actually put you in a better position than a forward contract. So therefore, under those conditions, a long forward contract is relatively more attractive than a long forward when the correlation is positive. And therefore, the long forward futures position is more valuable than the long forward position. And that means the forward futures price will be higher. Okay, so again, if the asset is positively correlated with interest rates, that means we're better off whether rates go up or down. And so the futures, with a futures contract, the futures price would therefore exceed the forward price. Now, of course, this implies that if the asset is negatively correlated, with interest rates, that means that the futures price would obviously be lower. Okay, so there has to be obviously the opposite. Now, if there's no correlation at all between the asset and interest rates, then the two should be the same. Okay, in other words, if let's say the asset has nothing to do with interest rates, then there would be no reason for the futures and the forward prices to be different. Okay, So now we're going to see how to hedge with futures contracts. Now, this is a very challenging activity. Forward contracts, you can get a contract that is exactly whatever you want, that exactly matches your position. So hedging with forward contracts is a breeze. It's easy. It couldn't be any easier because you have the right to choose whatever it is you want. Okay. Whereas the futures contract, as we know, you have to take whatever's available. So that makes it a lot more challenging to hedge with futures contracts. So what kind of decisions do we have to make? Well, number one, given that they're not customizable, and there's only so many contracts, there's only so many delivery dates, there's market to market, there's several things we have to think about when we hedge with futures contracts that we don't have to worry about with forward contracts. First of all, what contract do you pick? Now, keep in mind, you're trying to minimize the risk of your particular asset. So you want a contract whose asset is closely correlated with whatever it is you're trying to hedge. So here's a perfect example. What if I'm doing business in Iceland? Well, the Icelandic currency is the krona, which means crown. And of course, there's no futures contract in the krona. It's a very small currency. Hardly anyone uses it. Well, what can I do? I want to hedge my risk. Now, what if I do not want to use a forward contract, but I still want to use a futures contract? What could I do? Well, I could find a futures contract on a currency that is highly correlated with the krona, such as the euro. Now, Iceland does most of its trade with euro, so the correlation between the krona and the euro is very high. So if I choose a futures contract on the euro, even though it's not the same currency, it will do a very nice job of hedging the risk of the krona fluctuating. It's a compromise, but it's a pretty good compromise. There's no such thing as a futures contract on the Icelandic krona, but I can still get away with using a futures contract on the euro because of the close connection between the two currencies. And in fact, in Denmark, they actually have, let me go see if I can find an article about this. Denmark is not part of the Eurozone either. Denmark uses the krona as its currency, but recently, the kroner is tied. All right. In other words, the Central Bank of Denmark is obligated or committed to maintaining an exchange rate with the euro that does not deviate by more than 2.25% away from the euro. So what that implies is that the correlation between the euro and the Danish krona is going to be very, very high. And so if I'm doing business in Denmark, once again, I should be able to hedge my risk with a futures contract on the euro. Okay, and of course, just like many other small European countries, they do most of their trade with the Eurozone anyway. All right, anyway. What about the delivery date? Now, you know that there's typically for any contract, any futures contract, there may only be 4 delivery dates a year. And for the currency markets, it tends to be March, June, September, and December. But what happens if the date that you're trying to hedge, the delivery date for your whatever it is you're buying or selling, is not one of those 4 months? So let's say, for example, you are, sneak this in here. Suppose that you are going to take delivery of 100,000 Icelandic krona. Actually, I'm not sure. I think the plural of that is kronor. Let me just check that real fast. Kronor. Oh, okay. There you go. On August 1st. The futures contracts that are available on the euro expire in March, June, September, and December. Which is the best contract? Okay, well, there's a couple of ways of looking at it, but now obviously I either want to pick June or September. Okay, but I want to get as close as I can. But there's a lot of good reasons why you'd want to pick the contract that expires after your delivery date rather than before. Because before introduces even more uncertainty. If we choose June, we will need a new contract to cover the period from June to September, August. This introduces more uncertainty, which is exactly what we want to avoid. If we choose September, the price on August 1st, the futures price, is still uncertain, but we do not have to enter into a new contract. So the thinking in this business is that you're better off just having September and hoping that the price doesn't fluctuate too much, as opposed to starting up a completely new hedge in June, which you never know how much it's going to cost you. And even then, the contract itself will probably expire later on anyway. So what was the point? So instead, you're probably better off starting out with a long contract in the first place. Okay, so September is probably to be the better choice. All right. What else do we have to worry about? I'm trying to save it. It's taking forever. Oh, okay. So those are the decisions we have to make. Now, by the way, when we do use the kroner, the euro to hedge the kroner, we're engaging in what's called a cross hedge. So if we use the euro to hedge the Swedish krona, by the way, all those all those Scandinavian countries have a currency called the krona. It just means crown in those languages. That would be Sweden, Denmark, Norway, Iceland. I'm not so sure about Finland, but no, Finland's part of the Eurozone. They use the euro, but Sweden never joined. Norway never joined. Denmark never joined, and neither did Iceland. These are countries that tend to stay neutral. All right. Well, anyway, now the next question is, how many contracts do I buy? So what we're going to do here is look at an idea called the optimal hedge ratio. So let me just show you what I mean by that. Suppose, for example, that I will be buying 100,000 British pounds in September. Okay, a single contract for September delivery is written on 62,500 contracts, British pounds. How many contracts should I buy? Well, one is not enough and two is too many. So that raises an interesting question. How can I figure out the proper number of contracts to buy? Now, we're going to assume in these examples that we're actually hedging much larger positions so that instead of buying one or two contracts, we might be buying 100 or, so that way we can switch to 99 or 101. So here it's a little bit awkward because, our position is 100,000. So, but if we're hedging a much larger position, then we have a lot more flexibility with our the number of contracts that we might want to buy. So you might think that we're just going to match it up exactly, but here's what we're going to do. The basic approach is to hedge a spot position with a futures position of equal size. That would be the ideal, but it's not always possible to do that with these futures contracts. So what do we do about it? Well, here again, here's the British futures contract. Let's say our position, just by a lucky coincidence, is 62,500,000 pounds. And of course, we know that each contract is worth 62,500 pounds. Boy, that would be perfect. That means we can buy exactly 100 contracts and our hedge is very good. But it usually doesn't work out so nicely. We have to make decisions. We may, let's say we need slightly more, slightly less. We might have to switch to 101 or 99. But what we would like to do, though, is make sure that the hedge of our position and the position itself are as closely correlated as possible. Now, there's a formula here that is widely used in practice to help us figure out how many contracts we should hold if we are cross-hedging, where we're trying to basically minimize the variance of our position. Now, this is where it's getting a little bit more technical. Those sigmas are what we call standard deviations. This Greek letter rho represents the correlation between our two currencies. So this is often referred to as the minimum variance hedge ratio, which again minimizes the fluctuations in the value of our position. And the derivation of this is way beyond the scope of this class, but it's out there if you wanted to look at it. And so this formula has been shown to keep our risks down to an absolute minimum. Now, again, H star is, of course, the minimum variance ratio. Sigma S is the standard deviation of changes in the spot exchange rate or spot price. Sigma F is the standard deviation of the changes in the futures price. And then finally, this Greek letter rho is the correlation between the two changes in the spot and futures prices. So let's just say, here's a good example. A US importer is going to buy 100 million Swedish kroner in 3 months because they're going to import lingonberry jam. I don't know if you've ever had lingonberry jam. It's a Swedish specialty. It's absolutely delicious. But let's just say that the importer is going to spend 100 million kroner to buy lingonberry jam and bring it back into the United States. And we're going to cover this position with a short contract on 125,000 euros. Because we're using that because it has the highest correlation with the Swedish kroner. So let's just look at some numbers here. The volatility of the exchange rate between the two currencies is 20%. So the word volatility is another name for the standard deviation. Okay, so this is the volatility of the spot exchange rate. This one is the volatility of the futures price. And this is the correlation between the spot and futures prices. Okay, so now really all we have to do is plug them in. This is not a terribly sophisticated formula, but you can see it ends up recommending that we have a ratio of 1.09. And now remember, we're buying 100 million Swedish kroner. And one contract, let's see. I'm not sure how many, I guess I should look this up. How many euros are written underneath? Let me just double check this. On the CME, each euro futures contract is for how many euros? 125,000, all right. So what does that mean we should do? Now we're buying 100,000 Swedish kroner. So that ratio is 800. That's 800 contracts. And if this contract was written on the Swedish krona, that would be it. You're done. But according to this ratio, what they're recommending you do is instead buy 1.093 times 800, which is about 874 contracts. Why is that? Because the volatility of the kroner is higher than the volatility of the euro futures contract, which means we need more contracts to hedge the additional risk. So in other words, we're essentially hedging a riskier asset than the euro. So the euro futures contract is probably not enough to hedge our risk. So we compensate that by having more contracts. And so according to this formula, 874 euro contracts would be the best to cover our position in 100,000 Swedish kroner instead of just 800. So in other words, at 800, we might be underhedged. Our position would be riskier than it would be if we had 874 contracts. All right. Now, yeah, so here's, yeah, here it is. This is a different approach to doing the same thing. I just, went ahead and I multiplied 800 by 1.093. This is the more formal approach. The H star that we just calculated, and A is the number of spot assets. In other words, what are we hedging? And in the bottom, we're looking at the number of units in one contract. And so it ends up being the same thing. So in other words, instead of 800, which is what we would have had here, we end up with 874. Very good. All right. So summary, the number of futures contracts needed to hedge an exposure can be determined with the basic approach, which is 1-to-1, or the minimum variance ratio. Okay. So in other words, the basic approach would have said, go ahead and use 800 contracts. The minimum variance hedge approach is the one that says, no, go ahead and use 874, because you have to compensate for the fact that kroner are riskier than euros. Number two, without a futures contract available on the asset being hedged, the best choice is to find a futures contract on an asset that is highly correlated with the one that you're actually hedging. So that, for example, you could use euro futures to hedge your exposure to Swedish kroner. All right. Yeah, and the closer they're related, of course, the better off you'll be. Now, if you're doing business in South America, for example, let's say you're doing business in Brazil, you might want to hedge your risk with dollar futures. Okay. So yeah, I mean, if you're a European company, if you're an American company, you know, you don't need to worry about that, but so much. But if you're a European company doing business in Brazil, you might want to get a contract where you're given the right to buy dollars, because obviously Brazil does a lot of its business with the United States. If there's no futures contract whose maturity date matches the date of exposure, the best strategy is always to choose one whose maturity date comes after the exposure date, not before. And like here, we've already discussed this, but if we needed to buy Swedish kroner in August, the nearest futures contracts are at either June or September. We should use September because it's not only less risky, but it also, yeah, I mean, it means that there's less risk that we might have to take delivery of the kroner if we do not want them. So in other words, if you let the June contract expire, you're actually expected to take delivery of the kroner, which you may not want to do. So by entering into the September contract, you're guaranteeing that you'll never actually have to take the kroner if you don't really want them. All right, well, so now we're much more up to date on forwards and futures and arbitrage as well, not to mention present and future value and continuous compounding. So we crammed in a lot of stuff tonight, I think. A lot of stuff that will be very helpful in the rest of the course. And oh, and we reviewed correlation too. Man, this was a big night. Oh my God. And you found out the name of the Icelandic currency too while we were at it. So we did a lot of good stuff tonight. Next week, just remind myself what next week is. I think we might be taking a more in-depth look at swaps, but let me just confirm. Yeah. And then finally, we get to options. Now, once we get to options, we're going to spend pretty much the rest of the course on options, except basically the last week, which is value at risk. But pretty much weeks 4 through 7 have something to do with options. And that's just because they're so complicated that they require that much study to really understand them. And when we get to that point, we'll be able to do, in fact, even next week, I think we have some Excel examples. Yes, we do. Perfect. I want to use as much Excel as possible in this class because I think it's the best way to not only learn, but to also use these techniques in a real world setting. So whenever there's an opportunity to use Excel, I'm always going to want to grab it. And I hope you love Excel too, because of course you know how useful it is. All right, so yeah, let's, I guess there's no point in carrying on. I mean, we're done. I don't want to start a new chapter here because we'll just have to start all over again next week. And I'm sure you're all tired. It's been a long day and all of a sudden it's daylight savings time and it's got dark a lot sooner than we expected. So let's cut it off here. And then next week, we'll look at swaps in more detail, specifically currency and interest rate swaps. And then we get to the big section of the course where we get to focus on options, the most fascinating securities in the world, in my opinion. And we're going to learn a lot about them and how they're used for hedging strategies, how we can speculate with them, how they're priced, how the risks are measured, hedging strategies, you name it, we're going to do it. All right. So we'll stop here, and I guess I'll just see you all next Monday.
Thank you.
All right. You're welcome.
Thank you.
All right,
Thank
you're
you.
welcome. Okay. Good night, everyone.
Good night.
See you next time.